Hi, I'm Brandon. I'm back for the last chapter summary of chapter 42, last chapter we were going to cover. And this one is on investor protection, insider trading, and corporate governance. So first part of this chapter goes over the Securities Act of 1933. So this came up to, this is for initial sales of stock. It basically, like the overview, if you want the short version, it prohibits fraud. When trading sales of stock initially, like right away for a business, like types of stocks or bonds or different like that. So with this, they require that you need a registration statement. And there's like a pre-filing period, a waiting period, and a post-effective period. So then in 1934, they came out with the Securities Exchange Act of 1934. This deals with a lot of regulation, with the SEC getting involved. So the book said this is for like assets with excess of like $10 million. Example they gave is like with recap. This is like with recapture by a corporation of all profits realized by an insider purchase or sale within a 6-month period. So with this, there are a lot of violations, civil and criminal. Like one, you could end up paying like $10 million for like bad insider trading, or you could spend like 5 to 10 years in prison too. So it was very, I would say, frowned upon in the stock exchange world. They really cracked down with the SEC, getting really involved in it. Then there's state securities laws. This deals with like intrastate dealing of securities, of stocks and bonds. And then lastly, like corporate governance. This is a relationship between corporations and its shareholders, rights and responsibilities of them. How they should act, what like laws, like how they should abide by. So different, like with corporate governance, there's also like stock options, and a stock option is an option that they give like people in charge of the company an option. They can instead of, if they meet like a certain goal, or instead of getting like paid in actual dollars, because they can go for an option to just retain stock of the company. And that's why CEOs get so rich, is because they use these stock options to retain stock. And then they've also been, with corporate governance, they promoting accountability. We learned about this in my auditing class quite a bit. Board of directors, they keep people in line for making sure like the CEO or the managers are in line, but then the board of directors could also be out of line. So they have the audit committee, which is separate. They deal with like internal audit, making sure that everything is done right, and they deal directly with the auditing, like the auditing company that comes in. There's also corporate governance, SOX. Sarbanes-Oxley is passed. This deals with like internal controls. Many companies, I guess like Enron, a lot of fraud and manipulation, a lot of money stolen. So that's where Sarbanes-Oxley came up, and that deals more with like internal controls, keeping the duties separate, so one person cannot steal all the money and everything. So that is chapter 42 summary.